Hi everyone, we're now going to take a look at Chapter 3's Chapter Review and Self-Test Problems, which were great review of the different concepts we learned this chapter. So I'm actually on page 81 of your book. So you're given Phillips Corporation, and you're given their balance sheet and their income statement. And you're asked to do a few things. The first thing is identify sources and uses of cash. So what were the major sources and uses of cash? Did the company become more or less liquid during the year? What happened to cash during the year? So we're going to use our balance sheet and income statement to do that. Then they ask us to do a common size statements, prepare a common size income statement. How do you interpret the standardized net income? What percentage of sales goes to cost of goods sold? So some questions to be answered there. And then finally, using these financial statements, let's calculate some of these key financial ratios. So we have some liquidity ratios and asset management ratios, and then solvency ratios as well. So some of those. And then finally, calculate the ROE for Phillips using and break your answer down into the component parts using the DuPont identity, which was our last component. So those are the requirements. So you have your book in front of you. Let's take a look at what we find. So in the first area, the first thing we want to do is determine the sources and uses of cash. So remember, increases in assets and decreases in liability indicate that we spent some cash. So when you increase an asset, we spend cash on that asset. That's the assumption. If a liability decreases, it went down, that means we paid on a liability. The opposite is true then. If there's decreases in assets, we didn't spend as much, so there's an increase in cash. So that's a source of cash. And if liabilities go up, we borrowed more money, or we owe more money, so that means we didn't spend the cash, or a source of cash. Phillips used its cash primarily to purchase fixed assets and to pay off short-term debt. So let's take a look. Source or use of cash. First of all, accounts receivable. Don't worry about cash, because that's what we're trying to find out, right? Accounts receivable. It went down, so it decreased. So if you think of it, when would accounts receivables decrease? When we collect more money. So that's a source of cash. Inventory went down. So we didn't buy more inventory than we had at the beginning of the year. So that was a source of cash. Net plant and equipment decreased. I'm sorry, it increased. It increased. Just taking a look here, which is a use of cash. So we bought more, so we used cash. Accounts payable, it increased. So that means we're borrowing more money. When it comes to accounts payable, we didn't pay for stuff we owe on it, so that's a source of cash. Notes payable decreased over the time period, so that's a use. So overall, there was our long-term debt increased, so we borrowed more money, so that becomes a source. Common stock stayed the same. Retained earnings increased, so that's considered a source of cash. Okay, so remember, accounts receivable and inventory are our current assets. So our sources of cash, 224, but then we also have a source related to accounts payable. So working capital wise, we increased cash. So there were major sources. So the major sources of cash were long-term borrowings and reductions in current assets and additions to retained earnings. So we look at where the sources are in our long-term debt. But it also tells us the major uses of cash. were the purchase of net fixed assets and notes payable short term. Short term. We have a source of cash in the long term. So that's what they wanted us to do here, was look at the balance sheet and determine the major categories, sources and uses, and then identify what were the major sources and uses, and did the company become more or less liquid? What happened to the cash during the year? So if we keep going, the current ratio went from 0.56 to 0.49 during the year. So the firm's liquidity appears to have declined somewhat. However, the amount of cash on hand did increase by 5. So is it more liquid? Well, if that current ratio decreases, we'd have to probably look at the liquidity ratio, the quick ratio, to really determine if it increased or decreased. So we can do that. We could take the 210 in cash plus 355, ignore inventory. So the very liquid assets are 565, divide by 1922, current liabilities. I'm getting 0.29. Let me see. 0.29. So they have 29 cents in liquid assets to pay off current liabilities in 2017. Let's see what it was in 2018. 310 plus 328 divided by 1725. They have 36 cents. So the liquidity is actually doing better. They're able to pay off their liabilities better with very liquid assets as compared to 2017. So I don't agree with that. It didn't decline to me if you look at it from a very liquid calculation. Let's go to 2. We've calculated the common size income statements here. Remember, common size means you are now doing what we call vertical analysis. So you're going to take your income statement and convert it into percentages. When you complete a common size income statement, you're going to take each item divided by sales. So sales divided by sales is 100%. Cost of goods sold would be the 2816 divided by the 4053, or 69.5%. Depreciation would be the 550, it's right in your book on page 81, divided by the sales of 4053, giving you 13.6%. Do the same thing with earnings before interest and taxes. Do the same thing with interest paid. Take the dollar amount of each divided by sales. And ultimately, when we get to net income, take 146 divided by sales of 4053. Dividends, you would take 47 divided by 4053 to get 1.2%. And the same with the addition to retained earnings. 99 divided by 4053 gives us 2.4. So we're taking that 3.6 and letting people know, here's how much of that went to pay dividends, 1.2% of it, and the other 2.4% of income was added to retained earnings. So it asks us, what percentage, how do you interpret the standardized net income, first of all? So net income is 3.6% of sales, because this is the percentage of each sales that makes its way to the bottom line. The standardized net income is the firm's profit margin. So for every dollar of sales, 3.6 cents of it remains as net income after paying off all the other expenses, including taxes and interest. How much remains before paying off taxes and interest, purely from operations? 17 cents from 17% or 17 cents of every dollar of sales. Then it wants us to know to determine what percentage of sales goes to cost of goods sold. Well, we calculated that 69.5%. So what this is saying is almost 70% of the sale price is how much the inventory we sold actually cost us. So we write it up 30 cents on average. Now our next calculation. So you're going to have that balance sheet and income statement in front of you so you can make sure you know where these numbers are coming from. The current ratio. I want us to calculate each one, and more importantly, you want to know what it means. It's very easy to calculate these. It's a percentage, and you're not expected to memorize all these calculations. If you take current assets, total current assets from the balance sheet, so we're calculating these for 2018, divided by current liabilities, divided by current liabilities from the balance sheet, you get 0.49 times, or how I like to look at it is for every dollar in current liabilities, the company has 49 cents in current assets. So you can't even pay off your current liabilities once with your current assets. You can only pay them off 0.4 times. The quick ratio will give us a better measurement of liquidity. So now we're just focused on very liquid assets like cash and accounts receivable. So we take those two assets, which are 525, 215 plus 310 in 2018, and divide by current liabilities of 1725 or 0.3 times. So for every dollar of liabilities, there's only 30 cents of really liquid assets to pay them, or you can only pay them 0.3 times. Remember, we're not judging, we're not determining if it's good or not, we're just defining what it is, the number, and what it means. The cash ratio. How much cash do they have, just cash, to pay their current liabilities? So we take cash, 215, divided by current liabilities of 1725, and we get 12 cents. So for every dollar of current liabilities, this company has 12 cents of cash, or it can only pay their current liabilities 0.12 times, so not even one time. So is that good or bad? It depends on the past history of the company and their peers. It might be normal for their industry, or it may be bad, or it may be really good. I'm not sure. The next ratios we're going to look at are the management of assets. Remember, inventory and receivables. So the first ratio is inventory turnover, where we take the balance of cost of goods sold from the income statement for 2018, or 2816, divided by the inventory balance of 328. And we get 8.59 times. Now remember, that means how many times on average the company sells out its inventory, how many times it needs to replace it during a year. 8.59 times. I'm going to skip down to days sales in inventory, because if you take the number of days in a year, 365, and divide it by your inventory turnover you just calculated, that's going to tell you how many days on average it takes to sell your inventory from the day of purchase to the day of sale. 42.51. 42.51 days. Now, depends on your industry. Now let's look at receivable turnover. Here we take our sales, 4,053 for 2018, and divide by our receivable balance, accounts receivables for 2018, 310. That gives us 13.07 times. So on average, the company collects its accounts receivable balance 13.07 times during the year. If they divide that into 365 days, that tells us how many days it takes from the sale to collect the cash on average. So it takes about 27.92 days or 28 days for the company to receive their cash on average from the date of the sale. Again, remember, it's not a perfect calculation. Some people may pay quicker. Some people may take longer to pay, but this is an average. So if everybody does this calculation in our industry the same way, we should have very similar results. If we don't, we want to know why. Now we'll look at our solvency ratios. Remember our total debt ratio. Whoops. We're taking total debt. So this is the 1725 in current assets plus the 2308 in long-term debt. So 4,033 divided by all the assets. So it's telling us how much of our assets are financed with debt. So for every dollar in assets, we owe 54.6 cents on it, or 54.6% of our assets we still owe money on. The next calculation is the long-term debt ratio, where we take our total debt. Nope, I'm sorry. Give me a second. Where we take our total debt, long-term debt, and divide it by long-term debt plus total equity. So that would be the 2308 plus 3347 gives us 5655. Divide that into 2308. So all of our long-term investing, that's the owners and the long-term debt, okay, of that, 40% is in long-term debt. Okay, so we owe on all that long-term money we get from owners and creditors that loan us money, we owe 40.8% of those investments are in long-term debt. So it's just to determine how much we are involved in debt. Times interest earned. The times interest earned, we take the earnings before interest and taxes of 687 and then divide it by the interest paid, and that's right off your income statement, and that's 1.37 times. So this is showing how many times we could pay our interest from our earnings before paying any kind of interest or taxes. So the more times you can pay it, the more likely you will. So we could cover it 1.37 times this year. And the final calculation is cash coverage ratio. This is, I'm not as familiar with these as I am the other one, so just bear with me. Earnings before interest and taxes, that's right, earnings before interest and taxes of 687 and add back depreciation. So if you look at earnings before interest and taxes and look at it from a cash perspective, you would have to add back cash to get the total amount of earnings that are really available to pay off the interest, because interest was subtracted to get earnings before interest and taxes, and it has nothing to do with cash. We didn't spend that money anywhere. Now divide that by the 502. So the cash we made this year to pay off interest is really 2.46 times. So as I said, it's just measuring how well you can pay interest and how much of your company is being financed by debt overall and focused just on long term. So those were our major ratios for solvency, asset management, and liquidity. Now we don't have any practice with the market value, but we're going to take a look at the DuPont method now. So remember, the DuPont identity is on page 69. And it basically says this: return on equity is a combination of three major ratios: profit margin, total asset turnover, and the equity multiplier. So profit margin again, if you go back to, I'm kind of flipping around my pages, page 81 here. Profit margin again is net income divided by sales. So this company's profit margin is 3.6%. Total asset turnover is sales divided by total assets. So how well does it use sales to produce, how well does it use assets to produce sales? So for every dollar of asset, the company produces 0.549 cents of sales. And then the equity multiplier, which is determined by taking total assets divided by total equity, and that's 2.20. Okay, so we take those three results, multiply them together, and the return on equity is 4.4%. Notice that the return on assets, the return on assets would be the profit margin times total asset turnover, or 1.98%. Now, return on equity is important because it tells the common stockholders, if there's only common stockholders, how much of a return they're getting on the money they gave to the corporation. Remember, the corporation takes their money from the owners, invests it in assets, creates sales, pays off expenses, does the operation of the business that leads to profit. So this is telling only the shareholders how much of a return in a percentage-wise they got on their money. So if this was their savings account, they would have received 4.4% in interest. Return on assets tells all of the investors, creditors, and stockholders. Overall, we used all your money and we got on average a 1.98%, or that would have been, that's the way you could view, that would have been the interest on their savings account. Okay, so I wanted to go through that chapter review and self-test. Please make sure you post any kind of questions you may have on any of the information in this chapter. I know there's a lot on the discussion board.